Hello, everyone, and welcome. My name is Nicola Corzine, and I'm the Executive Director of the Nasdaq Entrepreneurial Center. We're so glad that you've joined us for today's incredible conversation on how ESG drives company growth. All of our entrepreneurs joining today obviously are building companies because of values and reasons that matter to them. And we're going to start to unlock a little bit today on how we can maximize the values, your beliefs, your criticality for building a company that matters into one that also drives incredible returns for you first and foremost as founders, and for all of the shareholders and stakeholders that you have affecting you in this journey too. If this is your first time, welcome. We're a nonprofit committed to helping entrepreneurs from all over the world realize their maximum potential and grow. And we build programs explicitly for our founders based on the challenges that they're facing, such as how do I build a core value-based company that can realize its maximum potential? Along those lines, we know it takes a village in support of this journey that you're on as entrepreneurs. So as you may have seen in that video, or you may have already noticed in that chat, we're taking a big stance right now to make sure that our entrepreneurs have access to all of the help that they need in building those types of companies. We have an incredible platform dedicated for mentorship for all. And if you haven't yet signed up, or you're curious to how you can give back in that capacity, we'd love to invite you to do just that and sign up for the platform today. It's an incredible opportunity and one that was built just for you in mind. Everything that the center does is free. We take no equity and we charge nothing in the process. It's all based on a pay it forward approach, but it's only made possible thanks to the incredible generous contributions of our donors, of our partners, and our sponsors. And so to each and every one of them, we say thank you. Thank you for believing in the work that entrepreneurs do around the world and for making our resources and education available in support of all of those for free. Now, I've got a couple of polls that I'm going to be launching, and then we're going to get started with this great conversation today. But before I do that, one quick housekeeping reminder. We want to hear from you today. So we're going to be opening up for Q&A at the end of each of the panels. Make sure you pop those questions into that Q&A function that you'll see at the bottom of the screen. And we're going to try to get to as many as we possibly can throughout the conversation today. I mentioned that all of the programs and the work that the center does is based on what you need. And so to do that, we need to hear from you at each moment that we can on how you're doing. So the first poll that I'm going to launch is going to ask you to take just a moment and let us know, how are you faring? These last couple of years have been a tough one, to say the least, and our entrepreneurs have certainly borne a very hard run to that. So if you could just reflect for a moment for us and let us know how you're doing. This helps us calibrate things like wellness, opportunities to really make sure that we're slowing down, to encourage you to make sure that you're getting the support that you need. This poll is allowing us to really get to shape and understand the challenge of how you're faring in these times. Thank you so much for sharing that. I've got one other poll that I'm going to launch right now, and that is simply asking, what's keeping you up at night? What help can we provide for you at a programmatic layer? If you can let us know if it's finance, if it's sales, if it's marketing. Are you working on building out that team? Are you all working on coming back to the office? Are you just hanging in there? Your answer to this question is going to help us get clarity and confidence on the programs that we're going to build forward for you in January and February, and look to bring in some incredible speakers that will help address some of these questions. So thank you for all of you taking a time to answer that question. I'm going to give it just one more second, and then we're going to go ahead and share those results. Right now, we've got finance and sales definitely working through, along with some scale, which is super exciting too. So let me share those results. As always, as entrepreneurs, you're never really alone in the challenges that you're facing, but we do thank you for helping us get smarter around the programs that we should be building on. Okay, so without any further ado, let's get started with the conversation that we have today. I'd love you to join me in giving an incredibly warm welcome to our three expert panelists. First up, I have Steve, our ESG advisory at Nasdaq. Joining Steve is Annalisa. She is a senior advisor at KPMG on the Board Leadership Center. And rounding out Bob, a partner at Sonsini. Thank you all so much for joining. If I can invite you to come on screen with me now and come off of mute. I'd love to start by inviting perhaps Steve to start by sharing a little bit about his background and how he was drawn into the world of ESG. Steve, could you start for us?
Yeah, and thanks for hosting today, Nicola. Very excited to join you and my fellow panelists. Quick background on my role. I'm one of our lead ESG advisors within our ESG advisory practice. I helped co-found our initiative a few years ago. So I've been with us from day one, and I've seen kind of the evolution of ESG really manifest into day-to-day conversations with management teams, boards, investor relations officers, and increasingly private companies looking to go public. And ESG is certainly a key component of that. But I've got a great team supporting our efforts, not only here in San Francisco, but in New York. And it's an exciting time really to be at the intersection between the investment community and the corporate issuer community.
Yeah, that's an incredible content area that hopefully we'll get a chance to explore a little bit more today. Annalisa, can I invite you to share a little bit about your great background and your journey to ESG?
Of course, and thank you so much for having me. I am with the KPMG Board Leadership Center, and we are a think tank that works within KPMG, drawing upon all of our wonderful, professionals that work with companies on a day-to-day basis of all sizes and in all stages of growth. And we focus on corporate governance and specifically looking at board oversight of the risks and opportunities that companies face. And certainly as it relates to both environmental and social issues, that is such an important part of the responsibility of a board. And I have been in this field for a little over 20 years, having worked in a variety of different capacities and also as a professor teaching undergraduate and graduate students about these issues. So I'm thrilled to be here today.
Well, welcome. We're grateful to have your expertise guiding us. And Bob, would love to hear and invite you to share a little bit about your background.
Hey guys, no, thank you. It's great to be here and really an honor to be with Steve and Annalisa. So I'm a corporate partner at Wilson Sonsini. I co-founded the firm's what was then called a clean tech practice in about 2004. And I've basically been waiting for this moment for the last 15 years. I started off as a nascent venture-focused practice. Now is really part of a broader ESG practice that we think of fairly holistically. For example, our ESG team involves our governance team in Delaware that supports boards in navigating ESG governance and shareholder activism. We have a funds team that supports our impact investors and creating and deploying funds towards ESG and mission-aligned investment strategies. We have, of course, our world-renowned emerging company and startup practice where we focus on advising climate tech startups and founders and the VC funds and the PE firms that finance them. And we have this spectacular climate solutions team built on the back of our energy and project finance team that supports corporations actually deploy projects, take actions to further their ESG goals, whether it's renewables or storage or energy efficiency or EV fleets, anything to decarbonize their supply chains. We have a team that helps them in those. So we're very excited at this moment in time and really happy to be able to have this conversation with you.
That's fantastic. We're grateful for 15 years of patience to get us to this point and a lot of learnings I know that are going to accelerate the next great 10 years ahead for this industry. Okay, so let's start maybe, Steve, with you. We all know that we're here because we're mission-aligned entrepreneurs, first and foremost, but it's also about trying to follow the flow of the capital a little bit and understand what are some ESG strategies that early stage companies should be thinking about. And then most importantly, a little bit today, how do those help unlock capital for our early stage founders? Do you want to kind of tackle that one to start with?
Yeah, it's something that our practice thinks about quite often, given its relevancy to the end user, right, the audience that we're serving. And I think where we typically start that journey is just understanding the formation of capital, right? How are we defining it? So capital is obviously, at the risk of stating the obvious, critical, right, in pursuing growth objectives, whether that's technological initiatives, human capital, maybe some CapEx, depending on what industry you're in. And so when we think about forms of ESG capital, that could take on, either that, equity classification or that debt classification. And increasingly, ESG is a big part of that. Not sure if the audience is familiar with the US SIF, but they've put out a lot of great research. It's publicly available, it's free. And, they've really found that about $1 in $3 have ESG in some way, shape, or form tied to that ESG capital now, which is about $17 trillion. So to ignore a third of that capital base, just from a business perspective, doesn't make the most sense. So how do you start maybe educating yourself or understanding how that capital is taking form? What we like to share with our audience is, if you need access to that capital, look upfield. And what I mean by that is you have this broad investment value chain where at the very top you have the asset owner community, and they have a variety of ESG objectives that they're looking to deploy their capital with. The middle portion of the investment value chain, which are those asset managers, right? So those asset managers are, putting their hands out asking for money, but then they have to deploy that capital with companies that match those criteria, match that, those data points maybe that they're looking to capture. And so really understanding and maybe looking upfield to the asset owner community can kind of give you some insight into what those developing ESG themes and trends are from a capital formation standpoint.
Really helpful, really helpful. Well, that's certainly not small money. And I think always understanding where the flow and the opportunities lie is a really important one. Bob, I guess flipping a little bit over to the incredible dual hats that you wear, both on the climate side and then obviously on the ESG practice side. Do you think that there's an increasing need from a regulatory perspective for looking at ESG these days?
Well, I think, when thinking about the regulatory drivers of ESG, it's really an incredibly broad landscape. And currently, the ESG megatrend is occurring against a backdrop of significant sort of administrative and federal action that is beginning to bake. At the same time, for example, this past year, even we saw among shareholder activism, you have this backdrop of Royal Dutch Shell being held partially responsible for global warming. You see activists succeed in placing 2 seats on ExxonMobil's board. You saw Chevron's stockholders buck management's recommendation and approve an investor-backed resolution that calls for, emissions reductions. So against that backdrop, you have the SEC with a steady drumbeat to reflect its intention and its focus on climate disclosure. And I think that we can expect that. I think, as early as March, the SEC formed a new climate and ESG task force within its enforcement division. This summer, Chairman Gensler spoke on the climate disclosures and signaled the need for a useful, like a decision useful approach to qualitative and quantitative climate disclosures. And just in September, we saw the SEC publish a form comment letter where it's through the comment letter process seeking enhanced climate disclosures. So, and then at the same time, right, so you have the SEC driving disclosure, you have the Department of Labor that is reversing rulemaking under the Trump administration and expressly enabling ERISA fiduciaries to consider ESG factors in its investment decisions. So what we're sort of seeing is sort of in the supply and demand, we're seeing in the supply of capital, the ability to make decisions on the basis of ESG factors. And then the companies you're seeing are being driven to enhance their ESG disclosure. And so I think, so we are seeing, and I think would benefit from some enhanced regulation around, disclosure standards, which has been within the ambit of private and quasi-regulatory bodies, including, for that matter, Nasdaq, of course, through its board diversity standards. And then, so I think, and then finally, within the ESG theme, I think no regulatory discussion would be complete in December of 2021 without acknowledging that Congress just, or at least the House of Representatives just moved forward with the Build Back Better bill, which includes a $555 billion climate change program with that would dramatically reduce greenhouse gas emissions in the U.S. by 2030 with significant tax credits and tax incentives. And and inducements for EV charging stations, electrical grid upgrades, energy efficiency rebates, and a green bank to promote renewables in low to moderate income communities. So yes, I think the short answer is I think that we should expect this rulemaking to continue to occur, both federally as well as through the different agencies, and this doesn't even begin to discuss international accords and what's happening at the state and local level. So, but I think we should expect that regulatory drumbeat to remain steady over the next several years.
Yeah. Back to the early point of find good advisors, keep them close to help get that information flow that you need to stay abreast of a lot of these changes, and fascinating conversations and good opportunities ahead. Now, Annalisa, on the other side, you work obviously a ton on the corporate governance side of things. And given your past experience with a lot of the ESG ratings groups, can you sort of share a little bit about what's happening with ESG from your world right now?
Yeah, absolutely. I think that, as Bob was mentioning, there's so much kind of scrutiny and, focus on environmental and social and governance issues from the investor side. But another thing to think about is there's also pressure and expectations from the employee and customer side as well. And so one of the goals of any type of ESG rating is really to evaluate the risks that are inherent in the company's strategy and business model, in addition to in their governance structure and their oversight of environmental and social risks, and ensuring, ways to kind of ensure that there's measurement of whether or not the company is mitigating those risks and hopefully taking advantage of opportunities as well. And so what we're seeing from kind of a broader picture is that organizations of all different sizes and at all different stages of growth are really thinking through how can we build in accountability for any goals or commitments that we've made to the public, or to our employees or to our business partners, customers, suppliers, etc. How can we ensure that any of those commitments are financed, are integrated into our strategic plan and executed in a way that achieves the goals that, whether it's a GHG emissions cap or a diversity, equity, and inclusion target, et cetera, achieves the goals that the organization intended. So a lot of that does come back to governance, and even in the pre-public space, it's still very important to have that governance structure in place to ensure that the entire management team is held accountable for achieving those goals, and also for communicating progress against any of the environmental and social commitments and goals that will drive we talk about driving growth, right? That drive the growth of the business. And again, mitigate any risks that may be inherent in the business model or in the strategic plan. So whether it's real estate that may be affected by sea level rise, or recruiting practices that may need to change given a hybrid work model or an all remote workforce expectation, having the governance structure, especially if we have an independent board, certainly in the post-IPO phase, having that independent board there to kind of, be the sounding board for ideas as to how to implement these ESG goals, but also to provide that kind of external communication, to be the voice to the shareholders and other stakeholders as to how the company is performing, so that management can continue to focus on the day-to-day operations of executing on the strategic plan and moving the company forward in its growth pattern.
I love that. And I love that you started with the consumer, the customer profile. I think a lot of interesting elements that have come up from our company slide have been around talent retention and honestly recruitment, and realizing that strong ESG practices drive forward incredible talent into a company where they see that potential, that commitment, and it's actually leading with that change in mind. Annalisa, you gave us so many great tips, but Steve, I'm going to throw it back to you because I'd love to invite your additional sentiment. I think for so many, there's this worry of like, oh, is that something that I build once I'm at a certain stage? And at a certain stage, often from what we hear from external public leaders, can often be that IPO window. But what about our private companies? How do we start, integrating ESG earlier into the cadence of, those that are on a growth path, but not quite yet at that exit IPO moment?
Yeah, and I'm certainly appreciative of, bandwidth constraints, especially in that growth phase. How do you find the time to do all this, right? Is ESG impactful in the private markets? Is it, equally impactful in the public markets? What I would say is, if you're a private company, you're obviously not competing in a vacuum with just other private companies. You're competing for the same TAM, right? Depending on what your products or services are, against, some public companies. We tend to think of ESG as, dollars and cents game sometimes. But there's a really important acknowledgement, I think that's worth repeating here, and that you're also competing for human capital, right? You want the best people working for you, right? Those are the individuals that are, driving that IP, driving those valuations, innovating, disrupting the industry that you're in. And unless you have, I would say, an authentic and, well-rounded perspective on ESG, you may have a tough time convincing, candidate XYZ to come over to your four walls and start innovating on your behalf. So ESG is certainly a human capital perspective as much as it is an ESG capital perspective. But I also would share how the conversation's changed a little bit since I've been with our practice. So if I were to go back, 18 months, plus ago, ESG was a big part of my day-to-day with public companies, and recently I'm starting to got a lot of questions from private companies trying to think about, okay, if we were to start dipping our toe into the public markets, getting ready, what is it that we need to do to be prepared? And so there is certainly work that has to be done ahead of time so that you are authentic. But just ensuring that you have a solid grasp of what those KPIs are, what those value drivers are going to be key and critical to you, right? Especially if you're a private company that intends to either list publicly or stay in the private markets, which is what a lot of the other companies are doing as well. So, short answer is, you're not competing in a vacuum. Doesn't matter if you're private or public. You're still competing for the same TAM. And you're still competing for that human capital that wants that authentic ESG story and that ESG fabric kind of built into the DNA of the company.
I love that. All right, Steve, I'm going to stay with you because you mentioned three very important little letters, KPIs. So when we think about ESG and like some of those important KPIs that can emerge for our earlier stage companies, what are some of the ones that you're kind of advising or generally thinking about right now from a formation perspective?
Yeah, so I'll admit, I'm a red-blooded, capitalist. I work for a stock exchange, so I always like to tie it to some type of financial impact. But I realize the importance of maybe going beyond the non-financials. And so what I would share is we hear from a lot of the institutional investment community on what data they want to see from companies, right? Whether it's private or public. And maybe I'll start with social in terms of what I'm hearing about the most. And one of the more common metrics that we hear from institutional investors are metrics that really tackle and track employee satisfaction and engagement data, right? So if you are not disclosing that information, that's entirely up to the discretion and the decision-making power of the company, right? That's your right to preserve that information internally. What I would say is a lot of investors will rely on something like a Glassdoor or comparably as a proxy to see how well your external, story and narrative is really resonating with what your employees are saying about your company. So it's very important to be aware of that. And I would add that little tidbit for social. On the E perspective, Bob was mentioning this a bit earlier. The SEC has certainly been beating the drum around E, around climate disclosure. It is something that I think that the markets are increasingly expecting companies to have a solid grasp around. So very high level, what I would say is having an understanding of what Scope 1, Scope 2, and Scope 3 is. These may be new terms for some of the audience, but I would encourage just Googling that or visiting the GHG protocol website. They've got some great educational material, and companies are increasingly reporting their emissions in those categories. And then I'll just kind of close my thoughts on this from a governance perspective, and I think Annalisa would have some great insight here. For those, I would say, mature, kind of further along the spectrum, companies having some indication of maybe metrics or KPIs that have relevance to the economics of the business, somehow tied to executive compensation, is where a lot of investors are increasingly interested in. But that's, again, probably for some of those later stage companies that have already collected some of those metrics, and it'll be dependent on the business model and the industry that those companies are competing in.
Awesome. And I was actually, is there anything that you would add on the G, the very important governance side of the house for KPIs that you've been watching?
Yeah, so definitely the executive compensation, and as you are kind of building your compensation philosophy for your company at any stage, but certainly in that pre-IPO and IPO stage, ensuring that it incentivizes the right type of risk taking. And you may not be at the stage where we see a lot of the larger companies, incorporating an environmental metric or possibly in the S category, a diversity metric into an incentive program. But at the very least, have it be part of your overall strategic plan development. So I think one of the things we talk about a lot with companies and with boards as they're asking questions about how the company is integrating ESG into the kind of day-to-day operations of the business, is that the best way to do that is for it to really be part of your strategy from the beginning. So as you're developing your strategy, ensuring that you're taking into consideration the company's impact on the environment, the way the company treats its people, and all of the other aspects of the E and S categories, so that it's built into not only your KPIs on a short-term basis, but also into your kind of long-term strategic goal, setting process that goes over maybe a longer-term plan as well. And if you start doing that at any phase, then it's part of the kind of, the way the business operates, part of the DNA of the company, and people won't see it as a kind of, we're adding in ESG later because we're going to the capital markets. It's part of the way the company does business in the normal course of its growth. In terms of, I will say, I can't go without saying that an actual KPI, once you're at the stage of having a board, an independent board, is to be sure that the board is comprised of diversity in mind. So keeping in mind not only the skills and backgrounds and expertise that you need should be varied and be drawing from a variety of different backgrounds, but also on a gender, race, ethnicity, sexual orientation, etc. So that not only are you eligible for the Nasdaq listing requirements that I think Bob mentioned, but also you get the perspectives from a diverse board that can really help you to grow to the next stage.
Such great tips and strategies in there, Annalisa. Thank you. Okay, venture capital used to be, that's social impact investing. But Bob, I want to come to you now and say, what is actually happening, broadly speaking, with ESG impacting venture capital? Is it starting to become more prolific? And where is it affecting, or not, as the case may be, things relative to valuation for our entrepreneurs as well?
Oh, goodness. Yeah. So across ESG related investment sectors, and I suppose my perspective is grounded significantly and sort of on the E part of ESG here, we are seeing sustained and significant capital inflows across all stages of venture capital, from seed and pre-seed to Series A, to growth stage and pre-SPAC or pre-IPO. Even within the ESG sectors, we're seeing just significant inflows broadly across hard tech, renewables, storage, mobility, food and ag, industrial, logistics and supply chain, and carbon capture, and for that matter, even carbon accounting. Basically, all of these themes that are directed at decarbonization and the tools that allow enterprises and individuals alike to measure, track, and achieve their sort of net zero goals. We are seeing significant capital markets demand for ESG related stories. I'm sure our friends at Nasdaq can attest, which in turn is helping drive up late stage private company valuations. So certainly a strong trickle effect. And while the de-SPAC market has experienced tremendous volatility this year, deals are still getting done, albeit now with greater transactional rigor and more rational valuations. In fact, just yesterday, we were excited to see our friends at Broadscale Acquisition Corp announce a de-SPAC with Voltus, a positive sign that the de-SPAC market remains viable for some late stage companies. And of course, we're seeing capital inflows from a broad range of new and old actors. We're seeing some familiar names returning to the sector, but mostly we're seeing new fund formation across the spectrum, from impact investors to CVCs to PE funds and infrastructure investors. In particular, I would say that there's been significant new capital formation, in particular with infrastructure funds seeking platforms that generate or enable sustainable assets. Which is to say, if you have an ESG related story, it is indeed a seller's market, and we're seeing valuations at unprecedented levels. It's hard to, it's hard to say whether we've seen this movie before. Certainly in what some of us describe as sort of clean tech 1.0, we did see frothy investment times. But, I think right now, I think it's a great time to be building a company in the ESG sector, and a great time to be raising capital.
That's awesome. That's so good to hear. We actually, interestingly, on the CVC point, had a couple of people that this year were talking about the importance of CVC showing up as a strategic initiative by the corporation that is then flowing into their decisions of where to invest in their venture arm internally, which is neat to hear you reflect that too. Now, you mentioned the storytelling aspect of ESG, and I think that is part of what our entrepreneurs are always doing, is realizing how they're weaving in their mission, their vision, their values into the story of why they're doing this work in the first place. Steve, obviously, it's not just about something that you put in an annual report to get that story across. So can you share a little bit about maybe some of the strategies that you've seen that have worked well, that really do come across with that authentic voice? And is there anything that we should be on the lookout for or try to avoid when we're actually comprising and developing that story in the first place?
Yes, would love to comment on this. I have a lot of thoughts on this. So the image that pops into my brain around this, where you said, ESG is just more than a once a year, sustainability report, and I can't emphasize that enough. The image I have, there was a great infographic I saw a while ago where it was basically this iceberg, and at the tip of the iceberg was, a sustainability report, and then the remainder of that image was all of the activities necessary and requisite to get to that point. And so because we're behind the scenes with so many other companies in a variety of industries, I can attest to that as firsthand that, there's a lot of work that goes into it, but it's work worth doing. And so how do we advise, companies to think about this maybe at an earlier stage? One exercise I've found to be very, very useful is conducting a materiality assessment. And what I mean by that is to look outside of your four walls, right? Look at what your competitors are disclosing, maybe what some of your peers are disclosing, If you don't have peers, maybe in that private space, look up market. Look at those, more mature companies that have, put the time in, have the headcount to do this. Just from an aspirational standpoint, it's highly likely that there are some topics that they are disclosing on or initiatives that they are pursuing that have relevance to your business. So it's effectively a stack ranking exercise where we can go through internally and start prioritizing which of these ESG topics have relevance to building value, to driving value, and communicating our story. I love it when I see a company put together a sustainability report with what we call a materiality matrix, because it's a nice chart. It's effectively a roadmap that shows you a laundry list of potential ESG topics that are useful to the business. And on the x-axis, it's indicative of the importance to you as a company. On the y-axis, it's indicative of how important those same topics are to external stakeholders, right? Those could be your peers, those could be your suppliers, those could be your customers, those could be your investors. And anything that's in that top right-hand quadrant is really where you should be focusing your time, attention, and effort, and really developing an authentic narrative around that, rather than maybe parroting some of your peers that may be talking about certain topics that may not have as much relevance to you. So I would certainly encourage those of you on today's call who are maybe at the earlier stages of developing that authentic story to think about a materiality assessment, because it really screams authenticity. And in my opinion, as well as the opinion of a lot of investors we've talked to, really best practice in thinking about that ESG reporting exercise.
I love that. And building that solid foundation, it becomes like that muscle build, right? After a time, it just becomes so much easier to do. So build it in the way that you want to from start, and then you don't have to redo it later down the road. Speaking of redoing things later on the road and trying to keep abreast of all of the never-ending moving parts, it feels like in this field, Bob, what areas do you think that our founders, especially our earlier founders joining us today, should really be preparing for around ESG trends right now?
That's a great question. I was reflecting on this before the call. I think, so number one, I think that founders should be thinking about how they set the tone at the top of their company to establish a culture that recognizes this conversation that we're having around corporate purpose, because that conversation is not whether to take into account the interests of your stakeholders, other than shareholders, such as employees, customers, suppliers, and the communities and society at large, but it's really how to do so. So I think number one is just recognize that we're sort of in this emerging era of stakeholder capitalism, and founders, would, I think, be well advised to think about shifting the aperture of their founder vision to take that into account. I think number two, really along the lines of what Annalisa and Steve stated earlier, begin to think about how to integrate ESG metrics into your OKRs upon which you measure success, and for that matter, reward and compensate your team. I would say seek to establish a board of directors and board engagement, not only as a strategic resource, but also to embrace some of the risk-related duties of oversight and risk management that will build organizational resilience. I think become intentional around DEI and understand and implement best practices there. And then finally, I would say just keep in mind where this wave will break, where this, I'm not sure which metaphor to use, where the puck will be in hockey to skate toward. But we always begin with the end in mind when we work with founders, whether we're thinking about when they're raising capital or selling their company or accessing the public markets or doing an IPO. And just recognize that, from a deal perspective, we are seeing buyers, investors, and partners increasingly conduct ESG related due diligence. They're increasingly likely to be thinking about your ESG culture and compliance into their investment decision into your company. So I would be very forward leaning in having a culture and some developing some internal systems or guardrails so that you can be thoughtful as you begin to think about exit scenarios where these upstream companies, as Steve mentioned, who themselves have ESG metrics that they are measuring against, so that you can be, well positioned, when that time comes.
I love that. So we're not only securing capital through prioritizing ESG, but we're also building up resiliency, an incredibly important part of being on the journey of an entrepreneurial place. Annalisa, along those similar notes, obviously for our companies based in California, but I would say broadly speaking for all companies, board diversity. Let's come back there for a moment. California's got a law, obviously mandating diversity through from a gender lens. But what is your general advice on sort of thinking through both how that law specifically should be affected and prioritized for earlier stage private companies, and then more broadly speaking, how that might manifest across all companies wherever they may be based?
Yeah, absolutely. And I think it's important to know or to think about why board diversity matters, right? First of all, what the role of the board is, I think Bob and Steve were just describing in terms of, making sure that all of this gets integrated and taking that step back and having the kind of, experience from a career that they've seen this integrated and implemented in other companies. So the reason that board diversity is so important is because, just like any team, the board needs to be a high functioning group of people that can bring different perspectives to the founder and to the management team. And so investors of all types have been pushing for more diverse boards and more effective boards, first of all, and therefore more diverse boards in order to get that governance that is really the ideal goal of having a strong board of directors. And so in California, as you mentioned, there's actually two laws, and one, both of which are being litigated. I'm sure Bob and his firm can talk extensively about that. But both require companies that are headquartered here and that are publicly traded to have women on the board and members from underrepresented communities, whether it's from a racial and ethnicity background or sexual orientation. And other states across the country have introduced similar resolutions, and a few states have passed binding laws as well. And but no matter what the kind of local requirements are, investors and, as we've discussed on these other topics, other stakeholders, your future employees, your customers, are looking at the diversity of your organization and certainly the diversity of your leadership team, including the board of directors, as something that they would like to see reflect the customer base, reflect the society in which the company operates. And so how can earlier stage companies identify these directors, advisory board members, etc.? There are many groups that have been put together that have existed for decades to help elevate the awareness of very qualified candidates who maybe aren't on the typical board of director list of candidates that have traditionally been tapped for board service, and so some of those, have done also a great job of training and educating members of underrepresented communities that may not have thought about board service as a part of their career path, but absolutely have very strong backgrounds and expertise that would be extremely valuable for, a corporate board, an advisory board, mentorship, etc. And so I can list off the list of the organizations, but as you can imagine, there's a great group for a variety of different types of qualified directors that founders can tap into, whether it's Latino Corporate Directors Association or Ascend Pinnacle for Asian directors, several groups that educate and amplify the voices of African American directors. There's quorum from Out Leadership for LGBTQ plus directors, and then women corporate directors and a variety of other groups for directors who are female.
Amazing. Thank you for that. All right, so stay with us. We've got questions about to come up, and then we're going to do a quick break, and we're going to come back with our second panel. So if you have a question, now would be a great time to put it in there. I've got one quick question that I want to ask this amazing panel. Thank you again so much for the insights today. And that is simply this. What is one key takeaway that you want our audience to go away with if they had to leave right now and they couldn't come back and they're going to watch the rest of it on demand? What do you want them to remember from your experience? What's an important piece for them? Let's start with Bob, and then I'm going to go over to Annalisa and Steve round us out.
Great. Well, I think number one is I do think ESG is being driven into private companies to a significantly greater extent than I've experienced in my career. So I do think that, given that, that one commonly thinks of ESG as being something that that can be expected to apply primarily to public companies, I do think that we're really beginning to see that go downstream to earlier stage companies. So I think so number one is ESG is real. It's not something that is for public companies only, and that you can expect when you're raising capital or exiting your company that ESG will be part of the conversation. And so therefore, I think you should begin with that in mind. And you, as I think also for founders and young companies, just recognizing, I do think that we're sort of at this dawn of a new era around stakeholder capitalism. I do think corporate purpose is something that founders should think about. And that as they build their companies, not just to build shareholder value, but to recognize the importance of taking into account, your organization's impact on your customers, your communities, and your employees. So I think these are really, it's an exciting time to be a founder of a new company and to be growing a new venture-backed enterprise. I don't think what was good for, your parents, startup company is necessarily applies to your startup company. And I think it's a very exciting time, and I think ESG is going to be a significant driver as we continue to move forward.
Amazing. Thank you. Annalisa.
Well, that's a hard act to follow. That was an excellent summary. And I would say that kind of look at your company through an ESG lens and see this as an opportunity. So first of all, one thing that, maybe we haven't touched on enough yet is that many of you are already doing so many, great things that are supporting an ESG strategy. And so ensuring that you're looking at what you're already doing and looking at your current strategic plan and your current, governance structure, whether it's, a board of directors and a formal process, or just the systems and policies and practices that you have in place in your day-to-day operations, and see where those are in support of what external stakeholders are seeing as ESG goals. And so you can start now to gather that information, even if you're not going to be disclosing it. You have that information internally. You have the opportunity to start building those internal controls and good record keeping processes internally as part of your growth strategy, and making sure that you're using that information to mitigate any risks that are posed by environmental impact on your company, thinking through opportunities to mitigate your environmental impact on the environment, and thinking through how you're treating your people, which I'm sure you're already doing, but thinking through that in a strategic way so that you can tell that story to your future employees and to your customers and to your capital providers.
Love that. Thank you. Steve.
What to add?
Say plus, right?
All the words out of my mouth. Maybe I'll be shorter in my advice here, because I thought all that advice was fantastic. I'd like to turn this around more from an opportunistic standpoint, maybe not thinking about ESG as this obligatory kind of compliance-based thing, but what I would say is for those smaller, growth-oriented companies, you have a unique advantage over the maybe more mature, let's call them legacy, public companies that have been doing things for quite a while and maybe have to reframe or reshape their thinking on either data collection or ESG topic prioritization. You have a unique advantage in really establishing ESG into the DNA and the fabric, day one or shortly thereafter. And it really makes, I think, the process maybe a little more digestible when you think about the opportunity in standing up a program earlier rather than later. So you've got some wind in your sails if you're starting earlier as opposed to maybe retooling how things have been done for a long, long time.
Something that is always great for our startups, without doubt. Okay, there's been some fantastic questions that have come in. I'm going to try to get to as many as we possibly can. And I'm not going to point this to people unless I have to. But the first one that came in is really asking about B Corps. So again, I'm not going to point on people, but Bob, I imagine you might have a thinking on this. And the question specifically relates to how are VC firms thinking about B Corps right now? Are they finding them attractive to invest in? Is there any hesitation that remains around the B Corp environment?
Happy to take this one. Well, first of all, I think it's important to make sure we're being precise in what we're referring to. There's B Corps that are sort of certified by B Labs, and then there's sort of public benefit corporations or their ilk in various states that are legal entities that are formed with for the purpose of a public benefit. My view is that public benefit corporations are at the point in their evolution where they're being broadly accepted by the venture market. In fact, within the ESG space, our friends at Generate Capital just announced that they converted to a public benefit corporation. Our friends at Trove Recommerce are a public benefit corporation and just announced a significant round. So we work with a number of public benefit corporations, and we just don't see the trepidation that we once saw from the investment community. And in many cases, particularly those that are sort of retail or consumer focused, the strategic and brand halo effect of being a public benefit corporation can be a positive. And my view on this was substantially shifted, and I think the marketplace's view last summer when, in particular in Delaware passed some amendments to its benefit corporation statute that substantially eased the process for converting from either a public benefit corporation to a both out of being a public benefit corporation and into being a public benefit corporation in a manner that de-risked it from a governance and M&A perspective. So really, Delaware did the public benefit corporation industry a service by lowering some of the last impediments to ease of capital inflows. So yeah, I think if it is consistent with your business strategy, I don't think investor concerns over a corporate entity that has a statutory enablement of boards to have this tripartite balancing of shareholders, stakeholders, and the public benefit. I think we just don't see that being something that would be a problem to capital raising.
Great. Really good. The next question that came in is an interesting historic one, actually, and that's just this: is ESG actually rooted in the UN SDG goals? Is it and is it sort of a catch-all for like all of the different government initiatives that are going on around the world right now? What are your thoughts on the interoperability between those companies that are sort of prioritizing or addressing UN SDG and its role with ESG? Whoever wants to take that.
I'm happy to raise my hand. This was a question that our team was just debating earlier this week. So we've got a lot of great consultants that help companies think about SDGs, how to think about messaging, right? And we want to make sure that we're enabling them to tell an authentic story. And so to the point on the SDGs and really their formation, yes, it's really at a country level, and that's the original intent. But what we would typically suggest as it relates to messaging around that is, of the 17 SDGs, there are targets that are tied to it. So if you intend to promote, your business or start tying some of your narrative to, say SDG, 13 or 5 or 6 or whatever it is, be prepared to explain, the impact that your business has and some type of target that is aligned with that, because it does, really highlight that authenticity. And I would say an understanding of maybe the perils of greenwashing, so that you're kind of getting ahead of the, maybe some of those hard questions on, well, how is your business really aligned with, say, SDG 13? And there's a lot of great resources on the SDG website that have all the targets that are tied to the 17. So those are my 2 cents, and obviously very timely given the debate our team had internally the other day.
Flying well, I love that. Okay, so one of the questions that I had to skip over, but I'm going to come back to it because it's right here in the Q&A, really surrounds COP26. And a question on how much of the $130 trillion are we expecting might flow down to startups. Anyone want to take a guess on sort of thinking through, and maybe it's COP26, but what are we thinking of right now, and its a material effect on startups and emerging companies there?
I mean, my view, I'll take a stab at this. The thing about startups is they tend to focus in denominations of, singles, tens and perhaps hundreds of millions of dollars. I think when you talk about assets and sustainable assets and infrastructure, you're speaking in terms of, hundreds of millions and billions of dollars. And I think the same holds true even if you look at the entire pie chart of capital that flows into climate. It's the substantial majority of that pie is asset finance. Another significant part of that pie is government programs. And a relatively skinny part of that pie is going to be venture risk capital, flowing into startups. So I would, but having said that, indirectly, the assets and the infrastructure are enabled by the startup technology. And so I think indirectly through customer opportunities or partner opportunities, that the capital, it creates opportunities for the startups. So for example, if you had a building or a campus of buildings that needed to dramatically reduce its carbon footprint, then they're going to be employing new technologies, whether it's lighting or other sort of HVAC controls or things that will generate customer opportunities for the startups that are developing the technology or the AI or the software that helps enable that. So I'd sort of say it's probably directly a very narrow slice of the pie, but I'd say indirectly it's quite significant.
There we go. Indirectly significant. Our startups love that. They find every opportunity out there to take advantage of that. Well, panel, it has been absolutely an honor, a treat. Thank you so much for the incredible insights. Really, so appreciate all the thoughts and all the humor and all the incredible advice that came out today. So much appreciated. We're going to take a very short break, 5 minutes for those of you there, just enough to hopefully go get another cup of coffee or tea or water, whatever is needed. And we're going to see you back in just a couple of minutes for our second panel. Thank you again, and we'll be right back.
Alrighty, welcome back. My name is Colin Main and I'm a program manager at the Nasdaq Entrepreneurial Center. And for this next panel, we're going to be discussing ESG strategies for early to mid-stage founders. Quick housekeeping note, we know there's still some Q&A in the box left over, so we're going to be opening up for live Q&A at the end of the session. So we'll try to get to the ones that are still in the box, and also please submit the additional ones you have in the Q&A function at the bottom of your screen. Without any further delay, please join me in giving a warm welcome to our special guest for this next panel. We've got Ella, who's the head of sustainable finance at Bank of the West. We've got Priya, who's the Senior Vice President of Management Liability at Woodruff Sawyer. And we have Veronica, who's the co-founder of VentureESG. Welcome. Hi, Priya, Ella, and Veronica.
Hi, Colin.
Great to have you back. I'm excited for this discussion today.
You.
Hi, all right. We've got Veronica and Ella in. Well, before we get started into the discussion, I'd love just for each of you to introduce yourselves briefly, talk about what you're up to in the world of ESG. So maybe I'll start with you, Ella. We'll go to you, Priya, after, and then round out with Veronica. Ella, welcome.
Thank you. It's a pleasure to be part of this discussion dialogue. Look forward to an engaging dialogue with all the panelists. But I am part of Bank of the West team. I head up our sustainable finance platform and programmatic approach to market. Bank of the West is we're well known as a major commercial bank in the U.S. We have strong footprint in Western states in California, but we do also operate in 20 other commercial hubs. We have small, medium enterprise business, wealth management, and also big retail footprint. So our objective is, and my objective is to help us to go after sustainability opportunities, to use our balance sheet to make a difference, really driving all our portfolio companies and, be a key player in the market. So thank you, Colin.
Amazing. Happy to have you. Priya.
Thanks, Colin. So Priya Huskins here. I'm a partner at Woodruff Sawyer, a full-service insurance brokerage firm. And at Woodruff, I'm an expert in director and officer liability exposure issues, as well as ways to mitigate that exposure through insurance and non-insurance solutions. I also serve on 3 public company boards, an S&P 500 public company board, a mid-market public company board, and a SPAC. And I'm glad to be here today. Looking forward to the conversation.
Excited to have you. All right, Veronica, round us out. Welcome.
Thank you, Colin. Great to be here. I'm Veronica Capustina, co-founder and partner at Houghton Street Ventures, a venture fund in London associated with the London School of Economics, and also co-founder of VentureESG, a nonprofit that we set up really to solve a problem that we were having. We were trying to solve for ourselves, how to find resources and solutions for early stage venture and applying ESG in our portfolio management, diligence, and to manage our own funds. So excited to be here. I think it's a very exciting time for ESG and very much looking forward to the conversation.
Agreed. Exciting times for ESG indeed. All right, so our last panel covered ESG trends in the market. And now our next panel, we're going to do a deep dive into each of the ESG pillars with you all. So Ella, let's jump right in with you on the environmental pillar of ESG. What's emerging in your space and why are where we are now?
Wow, it's actually a big question to answer. There's big momentum in ESG sustainability, all fronts. But if we take a step back, just go through everything we have witnessed, observed, globally as well as in the U.S., right, 4 or 5 years, the emergence of different pressure points, right? There's definitely the big conviction in the market towards why the businesses should invest in sustainability, should drive sustainability, right? There's a big investor pressure. And also, we are all have the more conviction around climate change, how it's happening, and how the impact that it's bringing to everybody. We are witnessing more severe events, physical risks, right? So we have, I think, experienced a lot recently. So, and the most recent I think that the changes are happening, right? You know, what's the role of private businesses, or just in general, the business community, right, in the market, in helping shaping global economies, the impact, the why the businesses should be more purpose-oriented, impact-oriented, rather than just driving profit and short-term focus, right? I think we've been debating, in the US especially, a lot of collaboration and, you know, consensus, influence have been achieved, right, to drive the business forward with purpose, with impact. Environmentally, climate change, you know, there's so much happening in financial industry, in the banking industry, to, you know, be razor focused on decarbonization in all sectors, industries, right? So it is all coming together. And also the last couple of years with COVID, we have experienced, you know, what that means, you know, the systemic issue, how it impacted globally and economically, different markets, the supply chains. And I will add one more thing, you know, I think we will speak about the S. So environmental issues, or working on environment is not just for the sake of environment, but also for the bringing really the justice around, you know, the communities, the impact, right, it is having on people, their you know, livelihood, their you know, the air pollution, right? So there are a lot of cross you know, boundary issues. And, you know, you know, there's all these injustices. So it's coming together for us to address, be more systemic, be more holistic, right, in terms of future state businesses, business models, and how organizations should be working together to achieve the, you know, good outcomes. So again, that's kind of a why. So there's going to be increasing pressure, more expectations out of businesses, any size, any type, to really have a hard look into what they are building, how they are bringing things to market, how they are able to influence their entire value chain, right, in terms of being more sustainable, laser focus on, you know, carbon emissions, making sure, you know, there's a pathway to definitely reduce those emissions. So, Colin, those would be, I don't know, key themes, key drivers, you know, strongly emerge, and big consensus in especially the U.S., coupled with, you know, increased federal policy support. So I think we are on a really good trajectory to start addressing and to take more, you know, bigger, bolder actions.
Well said. And Veronica, I wanted to double click into how have you seen ESG emerge in the venture world in the UK? But I'm going to take a step back, because you mentioned that your organization is solving a problem in the UK. Can you talk a little bit about the genesis of VentureESG, and then also fast forward into how you're seeing it emerge in venture in your industry?
Absolutely. So we started looking at this back in June 2020, really as a way to figure out how to do our own diligence and do our own implementation around ESG with early stage founders, you know, how to inspire them really to start looking at this from the pre-seed onwards, not from, you know, growth stage perspective. And we partnered up with another fund in London, started solving this for ourselves. What started out as a two-fund initiative and a framework that we put together based on our own research, we started sending that out to academics, other funds, and realized that there was a huge demand, that a lot of early stage funds were trying to solve the same problem, but, you know, the current framework of the UNPRI signatory was more applicable to private equity. Other resources weren't really available for early stage venture funds. So it really started out as a convening space for funds to share best practice and share knowledge. And in January 2021, we launched our first community call with 20 funds. Now we have almost 200 funds on board across Japan, Israel, Europe, UK, US. Today, actually, my co-founder Hannah Leach is launching our US chapter at the Pre-Money Conference with 500 startups in Miami. So it's a really exciting day for us. And, you know, we formed 4 working groups, free for GPs, so from internal fund management to portfolio company metrics to resources, and one for LPs, because our dream really is to unite. So what LP diligence inspires, GPs will end up doing for internal fund management, and they will then, the forcing function will then come for early stage founders, and it's a virtuous circle. So the pressure doesn't just come kind of downwards, it also comes upwards. And the other reason that we really thought this was the right approach is, we believe that, UN SDGs are incredibly important, for example, but ESG looks at your own house, right? And if you don't have your own house in order, it's very difficult to create proper impact externally. And we see that a lot more also as a driving force from founders, how they want to hire, how they want to build products. So for us, this is really a holistic initiative, which we've now spun out into a nonprofit called VentureESG, and secured separate funding for, which again, allows us to do a lot more with the stream and vision. And really, next year, really what we're going to be focusing on is rolling out a pledge. We're going to be publishing a study with the PRI based on survey results that we ran in Q4, and we're excited, and we're very excited to be bringing this cross-border. In terms of the UK, so we find that we think the UK and Europe are slightly ahead of the US, partly that's driven by regulation. So the Sustainable Finance Directive here for funds was rolled out, or it's going to be rolled out in force pretty soon, but already it started getting rolled out earlier this year. So that's driving a lot of adoption. So even funds which weren't organically thinking about implementing ESG best practice now have to start thinking about this, because they have to declare whether they classify themselves as fully focused on ESG, moderately focused on ESG, or exempt, right? And so that classification gives everybody a little bit of pause. And so we're seeing a lot of confusion around this new directive. We're trying to also get our heads around it, but effectively, it's not going away. And we see that whether or not we agree with how the legislation has been drafted, we see it as a huge opportunity. Because we think that this is going to just drive adoption and validate what a lot of people have already been working on in silos, and hopefully standardize the approach both, and again standardize the approach for how we communicate with founders. If it becomes market practice to focus in ESG, which we believe it will. We believe this will be table stakes and the only way to operate pretty much, I think, within the next few years. Then, this is something that founders will start thinking about if they haven't already done so the minute they start a company, not 5 years down the line when they're 100, 200 people strong, and cultural or organizational change is a lot harder to implement. We think the US, is coming at it from a slightly different angle. We think that there's again tons of opportunity to learn from each other, and we're taking some of those opportunities and running kind of panels and initiatives around that as well. I think the issue we see with the US, though, is that legislation is just slightly behind, or at least the approach is slightly different when it comes to fund management, and specifically questions like fiduciary duties. So we see a few fund managers state that as a reason for not focusing explicitly on tracking or certain things or doing certain things. But interestingly, they do that in private, so they do it in any case because they can see that it drives value, it drives investment returns, and it's basically good business. So I'll stop there. Well said.
Priya, I'm going to shift gears to the G pillar. You're on multiple boards and you're an expert, you have expertise in corporate governance. So I'm sure the G pillar comes up a lot. What's your advice on getting good governance started in the early days for founders who may or may not be thinking about it too much?
So Colin, you're right. This question does come up a lot. And I worry that I'm now going to be a caricature of an American business person who's a slow walker on these topics. But I'm going to stick by what I typically say, which is the key is calibration and, wait for it, sustainability. There's no area of business that a younger company, or even a more mature company for that matter, is going to be able to do everything all at once, and choices have to be made. Now, it turns out of all your panelists, I've got the easy draw, because of the three parts of ESG, governance is arguably the pillar that has the longest history. And frankly, there's not just a long history, but there is, I would say, directionally a very strong commitment over time by companies to having governance. People basically know, with rare exceptions, you can't run around saying, I don't like it, because you won't get support from investors onward. But having said that, when I think about governance, I think about it in two ways. What part of governance is actually part of risk management? And what part of governance is a conversation about something more? And I say that because most early stage public companies will end up focusing on the first, and for good reason. You don't want, as a new company, to lose the ability to take your company to the next level because your governance was a hot mess. And oh yes, I've seen that plenty of times. And so for early stage companies, my advice is to prepare to implement keystone practices and people that will allow you to get the right governance on track and stay on it. And a great example is, of course, independent board members. So from a governance perspective, independent board members on audit is really obvious. I think it's less obvious, but critically important to think about at an earlier stage than people often do, having independent board members on your nom-gov committee. And by the way, that's where ESG tends to sit for a lot of companies. When a younger company gets the benefit of directors that have seen a lot of things go well and go poorly, that gets incorporated into the DNA of the company in an earlier stage. And I'll just use an example that's going to feel almost trivial, but just think about the formality of board meetings and how that changes when you start to have outsiders, when you start to have independent directors. The mere fact that you have those people means that you start having calendars with articulated topics. This means that over time, you're going to develop a sustainable framework. It also means you're going to end up moving towards a sustainable cadence. And what I mean by that is creating an opportunity for management to know when there's an event, when is the board instead monitoring. And if you don't have a sustainable cadence, it's kind of a free-for-all and it's exhausting for everybody. Colin, I have had GC clients quit their companies because ESG demands on them became so great and there was no accompanying commitment to more resources. That meant leaving for them was the best option. That is 100% the opposite of what anybody who dialed into this program today wants, which is why I end where I started, which is think about a sustainable cadence. Start earlier, but think about the cadence.
I love that. And yeah, the process and the cadence are important when things get busier, as they say. I'm going to propose this question to the panel. Ella, I'll start with you. Veronica, I'll go to you next, and then Priya will round us out. So as we've been discussing throughout this entire panel discussion for the day, many founders are thinking about environmentally and socially responsible businesses from the beginning and aren't necessarily recording their ESG impacts to the standard that later stage companies are. So Ella, do you have any advice for them? And Priya, Veronica, we'll go to you next.
Yeah, that's okay. I think Priya said it right. There is no ideal state today, right? We are all marching towards establishing, you know, the true sustainability footprint or business model. So we got to start somewhere, right? Environmentally, you have to have some view into your current impact. You know, there are different ways, you know, again, and this varies if you're a product company, if you're a services company, and then from the product company, which industry, which business, what type of core operations you manage. Do you produce something? Do you source? What do you source, right? So it depends, but you got to start having the view of what is that impact I'm giving, right? Is it negative, right? So you got to find a way to mitigate and or eliminate the negatives, and then you can think about making a positive impact, right? I mean, especially if you're just talking about environmental. Carbon emissions, there's a big focus on it, right? What's the carbon emissions? Are there ways for you to conserve the use of energy? Are there ways for you to tap into some renewable resources? What can you do in terms of distribution, you know, the transportation, right there? And also there are a lot of different companies, I think in the tech space, dialed into this conversation. You know, there's huge need to eliminate waste in any industry, from any production or system, right? So what's the best way? You know, how do we look into, how do we capture the data? Because if you don't have the data, you can't improve it, you know, put the right transparency in place. So I think every company should start looking into what's my impact today? What's my that footprint, product footprint, value chain footprint, right? And then ways of solutions, what's out there? What can I implement now, short term? If let's say you're on the good pathway, and what's feasible for long term? What do I need to do? Do I need to collaborate more? Do I need to invest in something new? And how do I think about maybe raising capital for that stage, right? So those all should be, I think, part of the roadmap of the company. So this is what our objective is. It's how can the companies grow, and when they grow, do they see that future state, that business model alignment, right? To be more positive, to bring that more positive impact to the communities, to the environment. I think you gotta have a view on the role that you're playing.
I think that's great advice. Veronica, from a venture lens and from all the activities that you're in, any advice for early stage founders on getting started on measuring?
Absolutely. So I think starting with your own house and not thinking that you need to wait until you've raised any capital, or you've raised a certain round of capital. It could be two founders with a pitch deck. It's a good time to start thinking about how you're going to hire your third co-founder, your engineering team, who you're going to reach out to, where you're going to source that talent from, how you're going to word that job description. Simple things, simple interventions, but they really drive culture, because by the time you've hired your first 10 or 20 people, the culture is set, and it's a lot harder to change that down the line. Problems become embedded, and they don't get reported. So thinking really, for us, what we really advise, and what we within our community and within every founder that we speak to, it's intentionality. It's setting that mindfulness early. So you may not have money to hire a specific talent or HR specialist, but okay, delegate someone from the team to be that person, right? You may not have, capital to give everyone fantastic benefits yet, but it doesn't cost a lot to subscribe to some mental health and well-being incentives that can support your employees, especially during the high growth phase when things get really stressful. Start tracking basic measures like, what is the diversity of your team? Even when you're 3 or 4 people, why is that? Ask yourself that. Really, it's about reflection and awareness, and that's what really starts driving the change, and what we've seen work best. Look at your turnover, so why have people left? Conduct exit interviews. This isn't rocket science, and you don't need a specific HR portal to run any of these things. You can, as long as you're handling everything ethically in terms of the data protection and individual data, this is something that there's no excuse not to implement that from day one. Speaking of data, how are you handling your customers' data? How are you thinking about product design? Does your product alienate certain groups, right? Have you thought about the language that you're using in your marketing? Have you had anyone look at it, right? There are tons of organizations right now, and this is part of what we're building, a set of resources for people to come and check out that are either free or very, very cheap, in terms of being able to check what kind of, what are the simple mistakes you could be making as you're designing your data policies, as you're designing the kind of language around the product that you're building, that you're shipping. Those are the things that you should be thinking about, I think, day one, and tracking day one.
Thank you, Veronica. And you mentioned 2 topics that lead me into a great direction to lead it over to Priya, which are intentionality and values, which hopefully come up in governance discussions. Priya, we've discussed in the past that DE&I and governance and good corporate governance may be on the same terms, but not the same term. Can you talk a little bit about that and measurement?
I can, and as I think about measurement, I also want to say, Ella's comments about a roadmap and Veronica's comments about you set the culture much earlier than people realize, and you can do early interventions are incredibly important. And of course, DEI and ESG are not the same, but the DEI part is a strong part of the S and the G. And at some point, it just sounds like I'm reciting the alphabet. So I do apologize for that. My broader frame is that a clear benefit of starting with ESG in mind is that it can develop organically instead of some sort of grotesque Frankenstein mismatch. And what I mean by that is by starting measurements early, it's a free move when it comes to understanding what we as a younger stage company actually want to measure consistently over time. So a younger private company, what you can change what you're measuring, not in a like ridiculous opportunistic way, but what makes sense for your company as you scale, you can change that with very little consequence. And so my advice is start measuring stuff, absolutely, but be a lot more cautious about what you're publishing externally, even on your own website. So again, I'm not saying don't publish. I'm just saying be thoughtful about how much detail you put out there. And just to say it, it's really hard if you as a company have taken an extremely strong position on something like gender parity, and then you have a gender-related scandal. Like the scandal is bad. What happened is bad. But being charged with hypocrisy can make your culture just collapse. And so you don't want that. The other thing, just to say it, it's a little money-minded, but if you start with ESG and measurement early, you're in a much better position as you have this intersection between more robust measurements for your company and all the capital that's there now and we know is coming for ESG-focused companies. So we want to take advantage of that. And I think that's why Ella's roadmap comment is incredibly important.
I love that. And go for
Colin, help me chime in. I think we always talk about ESG in the context of it is something to manage, right? But I think the organizations are realizing it's not just something to manage, it's the way to manage the business. The two different things, right? So ESG, I think there was, so with the confusion between different acronyms, right? ESG is how we are measuring sustainability today. There are environmental factors, there are social factors, and governance. So all these factors could be risk issues for companies if they are not managed and if they are not really monitored, right? So if you're thinking about it, it is not something to manage on the side. It has to be part of your core kind of the strategy of your company. S is, employees, right? And how you're managing, like Priya's examples, how you're managing your talent, employees, well, kind of the benefits, right? Plus, this is a talent play as well. People are not looking to work for companies that doesn't, truly bring this at the culture level. So it is important that it helps set your strategy. It's not just on the sidelines, you start and then, take it as a side project. It's really how you're thinking about management board level, right? So it has to be the holistic way of your company's operating model.
One last thought. It's definitely, I couldn't agree more with Ella. It's definitely a value driver. And I think we need to move away from the risk, from seeing it as a risk framework or as areas of risk to manage to really seeing it as a value driver, not just for your internal company building, but for your customers, for the way your product is perceived, for the way your company brand is perceived. You're going to create a lot of brand value if you see ESG as a value driver. And, to tie up with Priya's point, the capital that's coming up, that's going to come into your business down the line, that capital is highly ESG regulated, So if you don't start thinking about this early, there's going to be a huge amount of catch up to do, much sooner than you think. So, and you don't need to wait for a board to start reporting on these things. And, again, completely agree with Priya, you don't need to publish any of this. This is for you, the management of the company, so what's going on in your own house, right? And you can spot problems early, resolve those culture problems early, and make sure you build the right communication channels within your company to set it up for success. And again, this is no longer an optional thing. It's really quickly becoming table stakes.
I love Priya. Anything to add to that?
I thought that was well said.
Amazing. Well, we talked about measurement, but let's get into metrics. So Ella, what are some key indicators from environmental lens that are easy? And you mentioned a little bit about this earlier, but they're easy and important to record as a growing company.
Environmental, I don't want to say it's easy. Everything requires intentional measurement, right? Effort. So you got to put in place. Somebody is accountable, responsible to track your energy use, your water use, the waste, especially if we have product companies. Waste is important because waste, we want to reduce waste, or where the waste goes, right? We gotta be intentional. You may need to tap into some partners, but you can do a lot of benchmarking, right? In the space, some companies are ahead of you, some companies are behind. That's okay. This is collaboration. You will not configure something from scratch. You always find good examples, good case studies out there. In whichever industry you operate, there is a benchmark. In fact, the good thing is benchmarks are increasing every day, right? Every year we talk about moving from point C to point D. So that's, again, in terms of measurement. And I would say, I echo Priya a little bit. Don't put out there in terms of transparency, the things that you can claim, you have to provide evidence, because there is a lot of greenwashing we talk about in the consumer products. We see claims, and then you go try to trace them. So you make sure you stand behind. Everything is evidenceable. Everything is, certifiable to certain standards. If you do, please put those, definitely in your transparency, in your reports, at your website, because, that means that you are walking the talk. You're saying if you're environmental conscious, then, and if you did the work, due diligence, and the management around it, you think you have good control, then put it out there. It will differentiate what you do.
Authenticity and integrity continue to come up during this conversation. Veronica, you discussed a little bit about the social pillar with employee wellness programs, and we did have a question coming from an attendee that's saying, how are companies managing the S in ESG for employee engagement?
Excellent question. With difficulty, but better and better. So basically, I think the first thing is making sure that there's frequent opportunity to speak up and have a direct channel of communication to whoever the appointed wellness officer is, right? And seeing what kind of putting out regular surveys, wellness surveys, engagement surveys. Those are some simple things that you can do. They don't require specialist tech. You can do it with Google surveys, which are anonymized. So those are some of the simple interventions that you can run. And in terms of, and I think an important thing to measure is employee happiness. Another way to do it is to hire an external provider to come in and help you do that. There's plenty of companies that are popping up around this space, so it's becoming easier and easier to do so. And at the very least, it should be done annually. Best practice should be once a quarter. So you can really measure. And you can try and understand where the dips are coming. Check it by department. And again, it becomes difficult to anonymize this at an early stage because departments are small. It's easy to see. It might be easy to identify who's particularly unhappy or who's not super satisfied with their working environment. But this is why you have someone. This is why you appoint someone with intentionality around wellness. That person is responsible in reporting to investors and reporting to the board, if there is a board, on why certain things are either spiking or dropping.
In our home, many of our homes are still not our safe havens. They are our offices and. Priya, we had a question, and you work with a lot of risk. What are some ways to address or identify ESG risks for an enterprise?
So a couple things. One of the things is there's a sense in which I think I think Ella said it. The ESG part of risk is actually just part of management overall. And what I think is actually really, really difficult, and I'm just going to say it, is smaller companies really struggle. I think it's okay to expect that most of the path needs to be cleared by larger companies with a lot more infrastructure and a lot more resources. There's a question in the chat. Do people understand that if growing companies are taking a true ESG path, there's cost associated with that? That's absolutely true. And we have to just make a decision. Is that okay? For me, that question is similar to if you pay your frontline fast food workers more, do you realize that the output may be more expensive? Yes. Yes, we do. And I think there's a sense in which the consensus has becoming ever more, we're going to be okay with that. So Colin, your question is a little bit difficult for me because it will be specific to the company. But here's my suggestion. Consider recruiting some independent board members sooner than later. Everything will actually be better to the extent you have this natural mechanism that allows you to take advantage of some wisdom, but also creates a level of accountability. That is what a really good independent board member does. And I'm not suggesting that an early stage startup needs somebody from an enormous, Fortune 100 company. That's probably not a good match, right? But there are some very good independent directors out there that have seen it all and are in a position to help companies understand, for a company like yours, these are a set of metrics that I've seen work. That is actually pretty inexpensive and an effective way to start asking and answering your questions.
I love that. And without a crystal ball, coming out of COP26, where do each of you think that ESG is heading into 2022 and beyond? Ella, I'll start with you.
Lots of things happened, prevailed in the last couple of years. I think we'll see much more intense pressure on companies, businesses to help solve for climate, right? Innovation is big. US is a big innovation economy. So yeah, we may be behind legislation, all the taxonomy policy, but we are big in innovation. There's, huge human capital U.S. businesses, entrepreneurs bring, or collaboration that they can drive with global parties, counterparties to help solve for the gaps, to help solve, bring a lot of, the solutions that all industries, all companies need. I would stay tuned. Again, there are a lot of entrepreneurs on the call. Focus on your clients. Understand what they need to do, because if you are going to work with companies, corporates, I think you should be able to draw parallels. So what they are doing, where they are going, or what's happening in your industry will ultimately come and impact you. Doesn't matter you're private, small, big, right? I think there are a lot of resources, especially for small. I saw one question. I was going through the chat. There, what are the resources? There are available resources for you. And yes, it is costly to build sustainability plan program, but there is UN, the Climate Hub, SME Hub. In fact, the big major tech is working to help, build additional tools where you can do measurements, footprint measurements, carbon, water. So if you ask the questions, because this is all about if you ask the question, you'll find the answer. So just a little bit more, be more intentional. So just COP26 out of it, good momentum, great momentum. It's not going to bring any big bang, but I think in US we'll continue to make progress, continue to see investments. ESG or sustainability-minded companies, any company, even technology company bringing a solution is an ESG sustainability-driven company. So there's big market out there. There's big investment flow out there. Veronica, you know it, you live it. The biggest capital flows in the last 2 years, VC capital, private equity, has flown into climate focus conscious, you name it, climate tech or energy transition focused companies. Again, there's software piece, there's hard asset piece, there's technology equipment piece, right? It's all coming together.
What a perfect transition into my next question for Veronica, which is in the capital and venture world. Where do you see ESG increasing importance in 2022 and beyond?
really just, I'm beginning to sound a bit like a broken record. I just think that what we're going to get to is that this will no longer be an opt-in, right? And it's something that will be table stakes for fund managers, table stakes for companies, and as Ella said, it will be a huge opportunity for investment also, I think innovation is going to help us solve this, right? So it's the only way that we're going to make it through. So whether it's climate innovation, whether it's investing in the next climate tech startup, or whether it's supporting your employees in your own company or in your fund to reach their personal sustainability goals, either by considering the office space that you're renting, where you store your data in terms of just basic interventions, right? Which servers you're using, right? To simple things like bike to work schemes where that's possible, remote work arrangements to save people on travel, being mindful about your travel offset. Those are the kind of things that, at a fund level, you can start doing pretty much straight away. And for your companies, you can try and inspire them to do that as soon as they're able. I completely agree with you, Priya, that there's a cost associated with everything. So it's all about setting the intention, and having the awareness to implement those policies as soon as practicable. Yeah.
Awesome. That wasn't a broken record comment. That was new info. It was great. So Priya, looking forward, knowing the California new legislation on board diversity, do you see this trend continuing across the US and even the globe?
Absolutely. It's a one-way ratchet when people, realize, oh my goodness, did it turn out we were ignoring half the population when it comes to talent and expertise? Why, yes, we were. Let's stop doing that. One of the things that is notable in my mind is that investors were actually first front in terms of looking at things like diversity in the boardroom, diversity in upper management, and the like. Given that we're at a time of war on talent, I am particularly intrigued by the number of either young people anecdotally or through surveys, and young is like defined as under 40 as near as I can tell. So I'm not in it, I'm sad. But the point is, if you're looking at a war on talent, and it turns out there's kind of only a limited amount of money you can actually pay people, these other factors stop being soft factors, they start being key factors. And there are a lot of young people that will go right to your website and look at what does your board look like? What does your senior management look like? And it's not going to be great for you in terms of recruiting diversity, by which I literally mean having the best possible pool of talent if you have nothing to show. And so that can be a little chicken and egg. Props to Nasdaq for what you guys have done in terms of requirements around diversity in the boardroom. It is a one-way ratchet. It will continue. And having been on a public company board for a really long time at this point, my other comment for everybody is it is so much better when you start early before you have to. The public company board on which I sit, that's the biggest one, actually has had women in the board for a very long time, including myself. And so as these new requirements roll out, you don't have this kind of frantic chase to go find the few board members that the other people know who they think can, fit the spec. That's absurd. And so this opportunity for everybody who signed in today to the webinar to start thinking about things like this early, what that really means for you is, one more time, you're setting a cadence so that as you get bigger, you're better positioned for all of these different benefits that come from having a strong ESG focus.
That's well said, and a great segue into our final takeaways before we jump into Q&A. So if someone was to dial into the last 30 seconds of this webinar, Ella, Veronica, Priya, what's one key takeaway that you have for our entrepreneurs thinking about ESG today? Ella, I'll start with you.
Good. Oh, I haven't thought about it. Build your own framework, right? I'm trying to correlate with the question. So yes, there is lots of benchmarking best practices. There are guidelines available for ESG. You can study what ESG is. You can look at existing reporting frameworks out there. But just step back and think about where are you in terms of sustainability or ESG, everything, E, S, and G. start formulating a strategy if you don't have it. That's very important. You gotta have a view of the future. How is the future going to change? How are you going to be impacted? What does it mean in terms of your longer term, right? Longer term risk, longer term. And because as Priya is saying, you will not solve all ESG issues be done with it in a year or two. You have to evolve. You have to evolve your thinking, your platform will evolve, your partnership will evolve, but it has to be the guide for you. Okay, how am I going to deliver better impact, more impact, right? So that's what I do. I mean, if you don't have it, build it and understand where your gaps are and have a good line of sight in terms of how you're going to get that future state for you.
Thank you, Ella. Veronica, key takeaway for our audience.
Okay, I think the biggest one for me right now is we have a huge opportunity coming up in the next few years. We're in the biggest generational change in terms of capital holders, Colin, which you alluded to just a little bit earlier. So there's a huge downward pressure on venture from their LPs, from everyone, from the Nordic pension funds to all the other pension funds, to family offices, to folks who will be holding on to capital in the next within the next 5 to 10 years. That's the downward pressure that's coming down on venture. The upward pressure on venture is, as Priya said, the war on talent. Which founders face every single day. Every graduate right now wants to find a job with meaning, wants to do something with purpose. People are no longer, no matter where they graduated from, which background they have, which gender or which ethnicity they come from, they want to have meaning in their day-to-day employment, and that's creating an incredible pressure for founders to deliver that as they design their companies, as they build their startups, from the startup side, also on the enterprise side, I think as well. And there's also a huge fight for customers, right? So that it goes hand in hand. And as Priya said, customers are taking note. They want companies which align with their values, and they're paying huge attention to where they spend their dollars. So what that means is that there's a huge opportunity for venture to come out and what that means is founders want venture investors who can support them in this journey, right? So it's full circle, it's holistic, it's a huge opportunity, and it starts with venture. We're first money in, so we have to stand up and take responsibility and not just rely on later stage investors and public markets to set precedent. We need to start thinking about our own approaches and be thought leaders in the space.
Thanks, Veronica. And opportunity is a word that all of the entrepreneurs on this call love, I'm sure. Priya, round us out. One key takeaway.
So you're not going to be shocked by this. Regulation is important, but my inner capitalist loves thinking of ESG as a value driver. Whatever you decide to do, start early and think about what makes sense from a sustainable cadence. If everything is important, nothing is important. So I encourage everybody to think in terms of what are the areas, maybe only a few areas where you can be excellent instead of being a solid B- across the board. So make some choices, start early, and think about a sustainable cadence.
That's great. Great advice. All right, we're going to jump into Q&A. We'll try to get to as many of these as we can. Let's see. When discussing ESG with startups, there's a question about impact first or return first. Veronica, I'm going to put this one to you. What's your advice there?
Well, I think that if you're aiming for impact but you're not getting a return, then you have a business model problem. So it's about lockstep. So that's the way I've always seen it whenever I looked at impact investing personally. So that's my answer to that. Review your business model. If you haven't designed it properly, then you're going to have the trade-off. If you have designed it properly, then it's going to be a flywheel. So the more impact you create, the bigger the return you're going to get. So, and it's not always easy to do. It takes time to get that right, but it's possible. And I think technology is actually the huge, it's number one thing that can bridge that gap. So where we used to have trade-offs because tech was expensive, business model design was expensive. Now it's become a lot. Your sunk costs of testing different business models are much lower these days. So take the opportunity and review what you're doing.
Awesome. Ella, Priya, anything to add there, or should we go on to the next question? Awesome. Okay, great. So let's see, another question. How are you advising founders on the ever-evolving and overlapping ESG reporting frameworks? Ella, maybe over to you. Like you talked about measurement. There's so many ESG frameworks.
Yes, they're available. Yes, there are plenty of them. You know, I think the objective is if you spend time in looking at them, they're shooting for the same thing, but there's a variation, which is okay, right? So ESG is a growing field. It's a, you know, evolution of data will evolve, you know, go ahead. Will grow. I mean, there are third-party ESG companies that look, measure, profile, post. You can start with the known framework. SASB is very industry specific, the things that matter to an industry operating in, you know, a company operating in industry. That's a good guideline. There's GRI, there is, also I would look at some of the consulting third-party ESG companies, what they do, what's their scoring, the things to look at. I think there's enough for to be able to establish a good sound infrastructure framework for managing ESG.
Yeah, and as discussed before, it takes time, but it is you know, better to be proactive than reactive. Pre-question for you: if you're a minority founder with a diverse team, but somehow have less diversity with their advisory board, will that be a concern with investors, employees, everyone involved?
So I'm not particularly concerned about who's on the advisory board unless there's something very particular about your company and that advisory board. It doesn't, I just, of all the things to be worried about, the diversity of my advisory board is probably very far behind. What do you have for your management team, your senior managers, right? What do you have for N-1, N-2, and what does your actual board look like? So there are so many things we can be worried about. The diverse makeup of your advisors is absolutely good, but it's not hitting my top 10 is what I'm saying. Yeah. Feel free, panelists, to disagree with me, but we can only have so many issues.
No, I think that's well said.
Yeah. You know, there was a question about B Corps, which I know also came up earlier, and just for what it's worth, B Corp, lovely idea. It's a label, right? So you can not be a B Corp and you can do a fabulous job with ESG and other things. You can be a B Corp and be a scoundrel and a villain. So it's nice, but I don't actually think it wins the day. I think any intelligent investor or employee will take the next step to look and see what are you actually doing.
Yeah, I think that's really well said. I mean, it is in many ways a framework, but also a label. Let's see, so many good questions, and we only have so little time. Let's see. What criteria do impact ventures use to fund startups? Veronica.
Well, I think there's a distinction between impact investors and ESG investors, and some link the two and some separate the two. So let's start there. ESG is very much about, you know, managing your house, kind of your internal company practices, and SDGs is what you're creating in the world, right? I would say there's a ESG to SDG continuum. Absolutely, you can have both. In terms of from an ESG perspective, I mean, there are, I would say, 8 key issue areas. You know, we don't really have time to cover all of them, but if you go to VentureESG.com, you'll be able to see them there.
Awesome. Well, we're almost out of time, so I just want to thank you, Priya, Ella, and Veronica, so much for sharing your expertise in ESG today. And for all of you who are still on the call, thank you, and hopefully this is all helpful. If you want to learn more about this topic or others, please submit your feedback in the survey in the chat. Also, we have an upcoming IPO bootcamp in the upcoming week, so keep a lookout and sign up for that if interested, because many of these will be, or this won't be as deep dive in that conversation, but definitely will be brought up. So thank you all so much for joining us today, and we look forward to see you all online soon. Priya, Ella, Veronica, thank you so much.
Thank you.
Thank you so much. Bye-bye.
Take care.